Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest economic data out of the US and why the US market was so weak on Friday. We'll have a look at European inflation numbers as a gauge for what we're likely to see on the inflation front across the globe over the coming few weeks. And also, we'll look at South African data, which has shown some form of deterioration, but nonetheless, Fitch upgraded on Friday. We're going to start off with an update on energy markets and what's happening in the Middle East. Clearly, there's been an escalation again between Israel and Iran. And this morning, Brent is up about $3 a barrel, trading at about $100 per barrel. Over the past couple of months, we've seen a sizable reduction in oil imports from China in particular, and that's gone some way in offsetting the reduction in supply through the Strait of Hormuz. But that can't be a permanent solution. We know that at some point, Chinese inventories, should it continue at this trajectory, will get uncomfortably low, and China would no longer be able to have such low imports of oil, and that would put some upward pressure on demand and a commensurate increase in prices. At the moment, the betting market is pricing in just a 30% chance that traffic through the Strait of Hormuz gets back to normal by the end of July. And should we see Chinese imports start to increase again, we'll land up in an environment with increased demand and supply not yet quite able to meet that without a commensurate increase in prices. So there is still some uncertainty over the coming few months. We could well see a further spike in energy prices, and we will be providing updates on this on a regular basis over the coming few months. Switching to the US, we've seen quite an interesting turnaround in economic data coming out of the US. As an example, the job openings data came out last week, and we're looking at the highest job openings numbers since 2024. And it's not just that the job openings numbers picked up, the previous few months were revised up too. And what we've seen over the past couple of years is fairly steady downward revisions to the job openings numbers. And now we're seeing the number tick up with positive revisions. It's been a very good set of numbers with regards to job openings in the US. And with that, if you look at the Atlanta Fed GDP Now estimate, that suggests that Q2 growth, admittedly it is still early days, we still need to wait for quite a bit of data to come through for Q2, but that early estimate is suggesting that Q2 GDP growth in the US is running at 3%, which is a pretty good number as well. And then you look at the non-farm payrolls number that came out on Friday. The non-farm payrolls number was at 172,000 jobs added, well above the consensus forecast of 88,000. And just like the job openings data, if you scratch a little bit, the underlying data was even better than the headline suggests. As an example, if you look at the number of industries that saw job increases, that was more than 50% of total industry. So we saw widespread job increases. And this is the first time in about 2 years that we're seeing widespread job increases in the US. And if you look at the 3-month average of the non-farm payrolls series, which is a better estimate for us because of the volatility in the non-farm payrolls estimates, we like to look at a 3-month average. That 3-month average, just like the job openings number, is looking at the best number that we've seen since 2024. And just like the job openings number, we also saw revisions, positive revisions as well for the past 2 months. And that stands out relative to the trend of what we've seen over the past couple of years of fairly persistent downward revisions. So all told, quite a bit of good news coming out of the US. You've got a better jobs market by a different range of different metrics, and the GDP estimate for Q2 is looking pretty good as well. The market didn't like that at all, though. On Friday, we saw a range of US indices down quite materially, some down more than 2%. And the primary reason for that is you sit in a situation now in the US where inflation is well above target, and now the economic data is looking a bit better too. There's no reason for a cut. In fact, the argument for a hike has been strengthened quite materially over the past week. In fact, just on Friday, the probability of a hike from the Fed by year end increased by 20% to a 70% probability. That was the move just on Friday alone, according to what the market is pricing in. So the market is now pricing in a hike from the Fed with greater certainty, and that's got the equity market, a little bit jittery. And as a result, we saw a pretty weak set of returns on Friday. There's an extra consideration going in the background here too. Over the past 20 years, we've seen fairly consistent negative net equity issuance in the US. By that, I mean that equity buybacks have been consistently greater than equity issuance. And that supported dividends per share. It supported earnings per share too. And it's one of the reasons why equity markets in the US have been so strong. But we do sit in a situation now where the hyperscalers are spending much more on capex than they did before. And there's a question around the extent to which they can maintain buybacks. And at the same time, we're seeing some pretty sizable IPOs come through as well. And the net result of that is that net equity issuance is likely to be about $100 billion greater this year than last year. And that too is just something to bear in the back of our minds. We've had this constant support for equities over the past 20 years or so in the US. And there are questions around what's going to happen over the coming year, just given the vast amount of issuance that's coming through, and questions around whether buybacks can continue at the pace that they have before. Switching to inflation and Europe. Europe has put out their preliminary inflation numbers. They do so ahead of everybody else, so it gives us a good gauge for what's likely to occur across the rest of the globe. The European inflation numbers were roughly in line with the consensus forecast. You're looking at inflation of about 3.2%. What would be more concerning for the central bank is that core inflation is sitting at 2.5%. It's been above target for a little while, and it's not looking like it's going to come down anytime soon. And as a result of that, the ECB is expected to hike this week with another hike in September. So the market's pricing in 2 hikes from the ECB by year end. The market is pricing in about 1 from the Fed by year end. Switching to South Africa, we had quite a bit of data come out from South Africa. Some of it good, some of it not so good. We're going to start off with some of the more concerning data points, one of which is business confidence. This is a key leading indicator for private sector job creation, and it did decline in Q2. Maybe that's to be expected given the war in the Middle East, but it does nonetheless suggest that South African growth might be about to go through a bit of a bumpy patch. It wasn't just the business confidence data that came out, it was the PMI data too, and it also suggested that growth is likely to be a bit weaker than we might have thought a couple of months ago. So just further reasons in the back of our minds just to be a little bit concerned about the growth outlook in SA. There's no reason to be massively concerned. These numbers are at the margin, they are showing a deterioration, and perhaps that is what one would expect given the shock to oil prices that we've seen. But nonetheless, just reason to think that SA growth is going to go through a bit of a soft patch over the next few months. On Friday, though, Fitch came out and upgraded South African debt. And the net result of that is if you look at an average across Fitch, Moody's and S&P, South African debt is now sitting at about 2 rungs below investment grade. Now, Fitch stated to get an upgrade, debt to GDP would need to start to deteriorate. That's unlikely to be this year. Debt to GDP, according to Treasury forecast, peaks this year and then starts to decline next year. And should it follow that trajectory, we can expect an upgrade from Fitch and actually upgrades from the other rating agencies too. So the question then is, if we do ultimately get to investment grade, that is, we would need 2 sets of upgrades from all the rating agencies, what would that mean for our market? Well, based on current pricing across countries, across the globe, our model suggests that that would see about a 0.3% reduction in the 5-year cost of borrowing for the South African government. And that's pretty meaningful. It reduced the cost of borrowing for South African corporates too, and that should be quite helpful for our equity markets as well. So should Treasury be able to ensure that debt to GDP continues on the current trajectory, that would imply some upside for SA fixed income and SA equities over the coming 18 months or so. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.